Hey guys, welcome back to another video. And today, as you can see, the market's pretty decent, right? Tesla's up almost 5%, Google up 1%, Apple 0.22, and you have some red mixed with some green. Costco down, Disney's up by 0.10, Nike up 1%. So in today's video, we're going to talk about how to sell puts, cash secure puts. So instead of covered calls, you have cash secure puts because you're risking your collateral, which is capital, which is money. So in this example, we're using ARK. ARKKK. It's currently trading at $84.60, 63 cents. So first thing you want to do is pick an expiration date. So let's do 2 weeks from now. So January 21st. Make sure to click sell, and then make sure to click put. So this is right here is the current share price. So if you think that ARK is going to dip around, let's say $83 by next week, you buy this strike price right here, 83.18, and then if ARK at the day of expiration is below the strike price, you're forced to buy 100 shares of ARK. So that would be $8,300 because it's 83 times 100 shares. That's a contract. And if ARK is above the strike price, you keep the premium and you keep your collateral. So you don't have to, you're not forced to buy any shares, and you just keep the premium. I hope you guys understood that. Pretty much I've been doing the opposite, which is selling covered calls, and this is my Google Sheets format to keep myself organized. So far 2 weeks. Today week 3 started, but it expires next week, so that's why I haven't put the gains of this week of $101 into the profit. So far we got $263 worth of profit selling covered calls, which there's a video and I'll put it up in the video so you guys can click on it. And then closing costs around 124, but it doesn't matter because the important factor is the profit. The closing cost is just something I did, which you buy back the option in order so you can do another one. So as you can see right here, we did 3 different call options. So we did a 52 one, we did it, well, to explain it better, the premium was $71, but we closed 19, so we subtract, so the profit in reality is $52. So yeah, so I'm just gonna explain it real quick again. Make sure you click a stock that you trust and long term. That's not something easy like a biotech company that can just plunge 50% under a day. Make sure to click sell and make sure to click put. Make sure you have the money to do this strategy, because if you don't have the exact amount of collateral, right, that being cash buying power, you won't be able to do this. So you need to have the same amount of buying power as the strike price. So you make sure to click sell. You're selling a put. You pick expiration date. Let's just say February 4th. That's my birthday, so we can just do that. There we go, February 4th. So if we believe ARK is gonna dip below, let's say to 74.22, we click on it, and then if we get $105, that's what we get. That's a premium. So if ARK falls below by expiration date below $74, we're forced to buy 100 shares of ARK at $74. That being $7,400. And yeah, and if it's above, you keep the premium and you keep the collateral, and that's pretty much it. Simple, easy. Yeah, hope you guys enjoy this short video, and yeah, see you in the next one. Peace.